In the 1990s, he created a billion-dollar copper producer. In the 2000s, he launched what would become one of the world's top primary silver producers. And in 2015, he started what he believes will be his third billion-dollar company. This is the one gold stock to research right now. Visit futuremoneytrends.com/investright.
Hello, everyone, and welcome into CrushTheStreet.com. I'm joined today with another special guest. He's a favorite. He's someone who is a truth teller, digs for deeper than the mainstream propaganda, digs through the details, and pulls out amazing statistics. This man is John Williams of ShadowStats.com. John Williams, thanks for joining me today.
Thanks for having me, Ken.
John, let's start this conversation off here. Governor Jerry Brown of California is now parading around the state bragging about the $15 minimum wage. California is the first state to go to the $15 range. This is going to happen over the next few years. Now, as of January 1st, it was at $10, but just prior to January, it was at $9. So essentially, we're going from $9 to $15. And I got to ask you, we got California leading the way. Is California going to be able to sustain and support this drastic wage increase?
Well, that's a good question. While I sympathize with the need for people trying to make as much as they can, you have an issue here where the minimum wage is, particularly in California, is something that probably unemploys more people than it employs, and encourages undocumented workers coming from across the border to work for wages well below the minimum wage. So that effectively people are being denied work because they're due the minimum wage, which is more than the people hiring the other people are willing to pay. I've never seen it as being particularly productive. I mean, there are some industries in which it is I'm sure it does have some positive impact, but generally I favor a free and open market where people get paid in a competitive circumstance. You have a much healthier economy with that.
Yeah, well, we're definitely seeing a mass exodus of the producers here in California to other more tax-friendly states, less regulations, and you can't argue with the fact when a company shuts down, making $10 an hour is better than making nothing, and that's what we're seeing in large scales and even around the country with other businesses moving to other parts of the world, leaving the strong rules and regulations of the U.S. But I definitely see this as a problem. But getting into some of the government numbers, here we are in April, and we've just had the employment number released. And I got to ask you, John, is this as rosy as the BLS is leading us to believe?
Well, they have their own definitions, which are designed to not necessarily give you something that the average person would recognize as being reality. I have an alternative measure on unemployment. Right now, the government has it at 5%. It backed up from 4.9% that had been the lowest level in some time. But that headline number, keep in mind the government has 6 levels of unemployment. They're what they call the U3 unemployment. 3 is a headline number, and in order to be counted as unemployed there, one has to have looked for work actively in the last 4 weeks. And you go back in time up to the point in time where the peak, official peak headline unemployment was at 10%, and now you're down at 5%. That's not necessarily good news because there are two ways that unemployment can decline, the unemployment rate. One is, and the healthy one, the one you want to see, is where people who are employed get jobs. So they come out of unemployment and they go into employment, and that reduces the unemployment rate. But the portion of the people who are unemployed in those official numbers is so low, let me say 10% or 5%, that if they give up looking for work and the government drops them from their headline labor force, and a lot of that has happened, that also lowers the unemployment rate, because it's the unemployment rate, just the ratio of the number of unemployed to the labor force, and the labor force is those who are employed and those who are unemployed, and when the unemployed is relatively small, the decline in the count of the unemployed will lower the unemployment rate, even though those people are not gaining employment. So a lot of what you're seeing in the decline in the unemployment rate has been due to people giving up looking for work. Now, from the government standpoint, if people haven't looked for work in 4 weeks, but they've looked for work in the last year, they're counted in their broadest measure, which is they call U6. That's up around 10% right now. They're counted as discouraged workers. But after a year, they're dropped from counting there. I take an estimate of those who are continuing to really be unemployed, but no longer in the government's numbers, and effectively displaced workers, as you saw with NAFTA, as you've seen with this terrible economic downturn. These are people who maybe will never be able to work again for reasons beyond their control. And if you put them in there and count them the way the government used to survey people before 1994, you're up around 23%.
Wow. John, I got to ask you, all these manipulation, all these massaging of the numbers really is to paint the fake facade of a healthy economy, whether it's for political gain, votes. And, it trickles down to how people feel, right? And this is what I want to ask you about, is consumer sentiment. And this is an important aspect of people spending money, whether or not they feel strong about the future. If people feel strong, they're happy, they're optimistic, then, they're more likely to spend money because they feel like things are, going to appreciate, the stock market's going to go up, their house is going to be worth more. But I want to ask you, what specifically drives consumer sentiment, and are there things that, are being misleading when it comes to this number?
Well, there are two predominant measures, or widely followed measures. There's the University of Michigan's Consumer Sentiment Index and the Conference Board's Consumer Confidence measure. They both measure effectively the same thing. Over time, it's been shown that the way people respond to the surveys is heavily influenced by the nature of the way the press is handling the economy. No good correlation there between the relative positive or negative tone in the press towards the economy. Nonetheless, although both the sentiment and the confidence numbers are off bottom from the economic collapse, they're still at levels that traditionally would be in recession. And you go back over time, are parallel to levels seen at the troughs of a number of historical recessions going back in time. So that although the sentiment is up, and it goes up and down, I mean, if you have a bad day in the stock market and some bad press, you can almost count on the confidence numbers going down the next month.
So John, how is it that they gather this data? Is it just, a simple survey, a yes or no answer? I mean, what are they doing to collect this data?
Well, there are two different approaches. The Conference Board uses postcards. They mail out 5,000 postcards. They get about 3,000 of the back, and that they ask people questions. So they get the get the material from that. The sentiment is conducted by a telephone survey, about 500 people in a month. Neither of them are extraordinarily high statistical significance, particularly the early month estimate of the University of Michigan. I think there's something like 70 people they call on that. You look at the political surveying that's done, you find that normally you need well in excess of 1,000 people to start getting in, on a national basis, to start getting into the realm of meaningful numbers. Nonetheless, the approach there basically is to ask people what they think the economy is going to be doing in 6 months. You're going to be stronger or weaker. And the problem with that is that you're effectively asking the consumer to be an economist. Most people are not, and they'll tend to parrot what they hear in the media. That's why you can predict these things with the tone of the press. There was an old line pollster who died some years ago by the name of Al Sendlinger. He actually ran I believe it was the conference board number initially, and went on with his own numbers. What he did, and I found it was very meaningful in terms of predicting things, was instead of asking the average person, what do you think the economy is going to be doing in 6 months? And he'd survey 3,000 people a month by telephone. He would ask them, do you think your income is going to be higher or lower 6 months from now? Do you think the number of people working at your place of business is going to be higher or lower? So that he did it at the individual level, where people had a sense of how their business was going. I mean, I can't tell you how many people I've asked to say, boy, the economy's strong, and I say, well, that's nice to hear. How's your business doing? Well, I'm having some troubles. There's a big difference there. And you get a more realistic approach if you get the person assessing it at a personal level and then aggregating them, but I don't know anybody who does that anymore.
John, when it comes to the government and the stock market in general, in your opinion, how dependent is the government on tax revenue and the stock market going up on a positive consumer sentiment, a positive view that the economy is going in the right direction? And I guess the follow-up would be, to what extent will they go to continue to massage this sentiment to make it positive?
Well, you need having a positive outlook is generally a plus for the markets. So anything that you can do there to encourage a positive outlook will help. I mean, if you talk about the president comes out and says, oh my goodness, we're in a terrible recession, it's getting worse and worse, that'll actually tend to exacerbate the recession. I mean, the way people feel and look towards things, that does influence how things go. On the other hand, you have an underlying reality there that's very difficult to escape. And what you're seeing, I mean, if you believe the government's GDP numbers, the economy collapsed from 2007 into 2009. Then it started to rebound, recovered, I think it was in 2012, and now it's 10% above where it was before the recession. At the peak of the recession, the peak before the recession was 10% above that. I'll contend that the economy indeed collapsed into 2009, but it never fully recovered. You had some bounce off the trough, but basically you went into a period of protracted stagnation, and now the economy is beginning to turn down again. Yeah. And what you'll see, in terms of trying to make people feel better, those GDP numbers help. They're pretty much consistently overstated. And you see this in other series that also tend to get overstated. They have upside biases built into the numbers, like the employment numbers. And then they'll revise the numbers later, almost always to the downside, but they like to have a positive number up front. I know back in the mid-1980s, the Bureau of Labor Statistics introduced what they called a bias factor that they added into the employment numbers. And I talked to the people at the time as to why they did that, and they said, well, we had an embarrassing circumstance coming out of the 1983 recession, and that is that we underestimated the jobs growth. And from our standpoint, it's okay if we overestimate jobs growth, but we can't underestimate. Yeah. That's from a political standpoint.
John,
so they put the bias in there to keep that up, and that has happened. You see that in series after series after series. And what you just saw happen this last weekend, industrial production, Federal Reserve surveys that, massive downside revision. Second year in a row, yet massive downside revisions. The industrial production level now is below its peak, pre-recession peak, where it had been higher. Eventually, the numbers get revised lower. You're going to see that with the GDP, and eventually the reality will come out here. But it's not as happy as the government puts forth.
John, I want to ask you this, and maybe you could shed some light as to why they do it. But why do they feel the need to forecast and make projections, and then just compare the number to the actual, and if it's under or over, that's the mistake? Why not just report the numbers for what they are and forget all of the projections?
Well, usually the projections are made by the market. And there you have people who are playing the markets and trying to figure out what's going to happen. And if they're right, then they know how the market's going to respond. If they get it right, it also gives them something of a benchmark so that the number comes in weaker. They can expect a market reaction one way, or it comes in stronger, it comes in the other way. They'll tend to anticipate in the pricing of stocks, for example, what the number is going to be. You're not going to keep people from guessing what's going to happen or trying to model what's going to happen if in the process they can actually improve their return. So it's mostly, the guys who do it seriously are doing it to try and make money in the markets. On the other hand, if you get people, you get these big Wall Street places that will always put out a positive outlook to try and increase the consumer confidence, to help the markets, to help them sell their products. I can give you a specific example if you'd like.
Yeah, let's hear it.
Okay, back in 1989, I was predicting a recession in 1990. We had a recession in 1990, but at the time I was making the recession, I didn't hear anyone else making that kind of a forecast. The CNBC invited me on to present my case for a company recession, but where my views were on the downside of anyone else out there, they wanted to have someone with a counterpoint on the plus side. So they brought in an economist, chief economist for a large New York bank. The two of us sat in their green room before we went on the air, and he asked me what I thought was going to happen. I gave him my pitch on the recession. I knew he was not looking for a recession. But his response was, well, yeah, I think that's a consensus outlook. That shocked me. I knew of no consensus that was looking at what I was looking at. And we get on the air, I give my story, and then he says, we're going to have a booming economy in the year ahead. Now, my point here very simply is he knew exactly what was happening, but he had to meet the needs of his employer in putting out a story that would help sell their products.
Wow.
It's that simple.
Well, I from what I can tell, there's been a major disconnect from the economic news that's being reported and the stock market, because even a lot of the figures that have been coming out have not been that positive, but we have seen the stock market react in a way that, especially since the 08 crisis, it has gone up quite substantially on air, I would say. Regardless.
You're saying on air?
Yeah, I mean,
Yeah.
it
hasn't been on the underlying fundamentals, I can tell you that.
Yeah, so I guess my point is these forecasts and predictions have just been irrelevant to what to expect the stock market to do. And I guess, we are at the point now where, they're going to continue, and they have to get more and more extreme with painting a rosy picture, because the amount of air in this bubble, if I can use that again, is continuing to inflate, and it's getting worse and worse each day that goes by. So, John, I'd like to get your closing thoughts and just what you are personally suggesting people to do here as an overall advice in 2016.
Well, my general view has not changed. I don't look at the stock market as a place to put your money. I see a circumstance here now with the weakening economy, and here you're seeing something that's somewhat perverse, because of the weak economic news that actually can trigger some stock market rally. And the rationale behind that is that the Federal Reserve is looking to raise interest rates. And the expectation is that the strong economy, they can raise interest rates, and that's not going to be good for stocks. But if the economy is weak, they're not going to raise interest rates. So they're not raising interest rates, that's going to be good for stocks. So you get weak economic numbers, and what happens is the stock market rallies. Because the Fed's not going to ease. That's the game that's being played here. But at the same time, you also see the dollar weakening, and that's a very significant factor. The dollar is extremely overvalued, as I view it. I mean, I can't tell you precisely when it's going to go, but I think it's going to sell off massively, very possibly in the near term, but certainly over the longer haul. The rally we've seen since 2014 has been without substance other than a lot of very heavy manipulations. And as the dollar sells off, you're going to see continued spike in oil prices, which is going to give you higher inflation. And once inflation goes up, yes, indeed, you may see the Fed raise interest rates. That's not going to be good for the markets, but inflation is going to be the problem here down the road. And what most people are looking at, and what people are afraid to talk about, very simply, is what happened in 2008. Because in 2008, the system was on the brink of collapse when the people in Washington said, we need to work our bailouts here, or literally the banking system's going to collapse. They were not kidding. We should not have been at that point. But they did what they had to prevent the system from collapsing. They created whatever liquidity they had to. They bailed out whoever they had to bail out. They guaranteed all deposits. And of everything they did, they didn't do anything to address the underlying fundamental problems like the economy or the long-term solvency issues of the United States. They just took stopgap measures that pushed things into the future. We're in that future. We're still living with this problem. We're still living with a domestic and global banking system that is far from normal. And they did a lot with their liquidity games to try and prop the stock market. They've been successful in propping the stock market. I see that as a big bubble. But I see this as a very dangerous time where, irrespective of where the stocks go, in inflation-adjusted terms, you're not going to see any great return. The risk here going forward is that when they decided to bail out the system, they were effectively making the decision to accept much higher inflation in the future. There are people out there who are warning of a great deflation because of looming massive debt defaults, and that you go into a deflationary spiral from the debt collapse. Collapsing debt does not in and of itself create a deflation. Had they wanted to let the banking system collapse, then they would have been opting for deflation, because what happened in the 30s, the reason you had a deflation then was that a lot of banks went out of business. Now, you didn't have any FDIC insurance back then. So people had their money on deposit with banks, lost the money. The money disappeared, the money supply shrank by a third, and so did the economy. The decision to avoid that was made in 2008. We're not going to see that. The danger here going forward is going to be inflation, and it's likely going to be a massive inflation. I've been looking for hyperinflation. I sure was early on my timing, but the fundamentals are still there, and they're still playing out the crisis of 2008. So my advice very simply is, be real cautious with your investments, but have at least a good, solid hedge, a nest egg, to carry you through extraordinarily difficult times. The best hedge for inflation and for the craziness that's ahead here remains physical gold, holding physical gold and silver, precious metals. They will preserve wealth and assets through an inflation in terms of purchasing power. They're liquid. So that's I look at that as a primary hedge, and then generally hard assets such as real estate, even outside the United States. But understand you may have periods of illiquidity. I don't look at stocks as a good deal at the moment.
John, and just one quick follow-up question. You mentioned 23% unemployment as the real number, the one that you focus on. What do you see as this number going to when we do see the bubble burst, the employment unravel, the stock market unravel? What do you see as a realistic number this going to? I know it's speculation, but
Well, let me put it this way. If you were to look at an equivalent number of what I have back in the Great Depression, and people say, the unemployment was at 25%. That may have been the official estimate of unemployment in 1933, supposedly the worst point of the Great Depression. But that was, at that time, you had 20% of the population living and working on farms. Today, that's about 2%. So a comparable number, respectively, would be the peak of the non-farm unemployment, which was about 35% back then. If we get into a real Great Depression type environment, you might see something like that, but I don't even think it'll be measurable, because you're going to have all sorts of things can happen there. It's not going to be a happy circumstance, but individuals are creative, and the system eventually becomes self-righting.
Well, everyone, that's John Williams of shadowstats.com. John, if you'd like to share a little bit about your website with our audience, I know we would all appreciate it.
I'll be happy to. Thanks. The website is shadowstats.com. I put out a weekly commentary, at least once a week. Usually gets adjusted by whatever economic releases are being published. I try to give you the lowdown on the numbers as to what's really happening with them, and ongoing outlook as to the broader picture. You can see the headlines of the newsletters in the left-hand column of our homepage. We always like to pick up new subscribers. 175 for a full year, $89 for 6 months. But there's a lot of free information. In the top of the right-hand column, you'll see some hyperinflation reports. Although we're not in a hyperinflation, the underlying fundamentals in those reports are still in play. It'll give you good background as to why we are where we are, and we're generally where we're going. I also publish alternative measures on unemployment, inflation, the GDP. All that is available there as well.
John Williams, thank you so much for coming on the show with me today. I really do appreciate it. Coming on and just sharing your knowledge and digging through the truth and, the statistics. So thank you so much.
You're most welcome, Ken. Thanks again.